two of the loudest voices on Wall Street are pointing in opposite directions on the Nasdaq. One side calls it a memory supercycle with the AI trade still in the third inning. The other side calls it playing with fire, with Warren Buffett's own indicator deep in the danger zone. Both cannot be right. So in this video we walk it in 3 blocks. 5 bull catalysts, 5 bear catalysts, then the chart. First, let's frame why the Nasdaq AI trade is the most consequential equity story going into the rest of 2026. The Nasdaq 100 is now structurally a basket of AI exposure. The top 10 names carry the index, and almost every one of them is an AI capex beneficiary or an AI software platform. Earlier this year, the index pulled back more than 10% in a single quarter, then ripped back to new all-time highs in weeks. That V-shaped recovery is the setup. The market has already priced in a soft landing. The question for the rest of the year is whether the AI engine can keep that pricing honest. Let's start with what is working. 5 bull catalysts. Bull 1. The earnings growth gap is real, and it is widening. Analysts model Nasdaq 100 net income growing 19% year-on-year, against 11% for the S&P 500. That 8-point gap is not noise. It is the AI capex cycle compounding inside the index leaders, while everything outside tech grows at trend. Earnings growth, not multiple expansion, is what kept the Nasdaq's premium over the rest of the market intact through the spring correction. Bull 2. The hyperscaler capex cycle is the largest in tech history, and it is not slowing. The 5 biggest US hyperscalers are projected to spend roughly $720 billion on capital expenditures in 2026. On top of that, neocloud companies like CoreWeave are stacking on another $30 to $35 billion in their own data center build-out. That spending lands in Nasdaq company order books first: NVIDIA, Broadcom, AMD, Micron, server OEMs, power equipment, networking. The index is the direct beneficiary. Bull 3. The street's most vocal AI bull just put a 30,000 target on the Nasdaq. Wedbush's Dan Ives is calling for the Nasdaq to reach 30,000 within roughly the next year, on the back of what he calls a memory supercycle. His thesis: AI memory chip demand and supply are running at a 10-to-1 ratio, and the industry is still in the third inning of a multi-year build-out. Whether you take 30,000 as a literal target or just as direction, the institutional voice on the bull side is loud, specific, and well-funded. Bull 4. Forward demand visibility is the best it has been in any tech cycle. CoreWeave alone is sitting on a revenue backlog approaching $100 billion, signed and contracted. Microsoft Copilot crossed 15 million paid enterprise seats by the end of its second fiscal quarter, with daily active users up almost 3 times year-on-year. The AI software market is forecast to grow from $127 billion in 2024 to about $440 billion by 2029. That is a 3.5x in 5 years. Bull 5. At the company level, the leaders are not historically expensive on growth. NVIDIA is delivering revenue growth of more than 70% on a forward multiple in the low 20s, below its own multi-year average. Broadcom's AI semiconductor business is growing past 100% year-on-year. CEO Hock Tan has guided that custom AI chip revenue alone could exceed $100 billion by the end of 2027. That is the bull case. Real earnings, real backlog, real capex, and leaders that still look cheap on PEG terms. Now 5 bear catalysts. None of them cancel the bull case. They sit beside it. Bear 1. Warren Buffett's own valuation indicator is deep in what he himself called the playing with fire zone. The Buffett Indicator, total US equity market cap divided by GDP, is sitting around 227%. In his 2001 Fortune piece, Buffett warned that 200% meant playing with fire. The reading now sits roughly 1/6 above that level. Bear 2. Traditional multiples agree. The S&P 500 trades near 28 times forward earnings, roughly 65% above the 100-year average of 17. The Shiller-Cape ratio, which smooths earnings over 10 years, is hovering at its highest level since the dot-com peak. Price to sales and price to book for the broad index are both at all-time highs. Multiple different lenses, same message. Bear 3. Corporate profits as a share of GDP sit near 12%. The historic norm is closer to 7 or 8%. That gap matters because the bull case implicitly assumes margins stay at this elevated level forever. Milton Friedman put the math simply. Corporate earnings as a share of national income cannot stay above their historic share for long periods. Competition pulls them back. If margins normalize, even at the bull's growth assumptions, fair value drops materially. That is the math under the Buffett warning. Bear 4. Veteran economist Gary Shilling is calling a U.S. recession almost inevitable by year-end. Shilling's drivers: a frozen housing market, weakening corporate investment indicators, and a fading consumer. His equity call: a 20 to 30% correction by the end of 2026 is plausible, with downside scenarios reaching 30 to 50% given how stretched valuations sit. Shilling correctly called the 1969-70 recession. His track record is part of why this warning carries weight. Bear 5. The consumer engine is already showing fatigue, regardless of the recession call. Credit card delinquencies are rising, household debt levels remain elevated, and the savings rate has dropped meaningfully. The Fed's preferred inflation gauge is still printing around 3.5% year-on-year, well above the 2% target. Sticky inflation plus a tired consumer means the rate cut story that fueled part of this rally is on a much shorter leash than the bulls assume. If this breakdown is helping you, hit subscribe and the like button. It takes 1 second and it tells the algorithm to keep sending this to people who actually want it. Now the chart. We are going to read it in structure, not in single-day moves. The big picture. The Nasdaq printed a textbook V-shaped recovery off its spring correction low. That pattern is structurally bullish until it is invalidated. The trend regime is intact. The 50-day moving average remains above the 200-day, the golden cross from last cycle has not flipped, and the index sits above both. Until the index loses its 200-day moving average on a closing basis with conviction volume, the longer-term bull regime stays valid. 3 structural levels matter for the rest of 2026. 1. The pivot low from the spring correction, that floor is the line in the sand. Losing it on volume means the V is broken and a deeper retest is on the table. 2. The 200-day moving average, the trend filter. A close below means the regime flips from bull to neutral, and risk needs to come down. 3. The 30,000 round number Ives is pointing at the magnet on the upside. Round numbers cluster stops on both sides, so expect volatile reactions either way as the index approaches it. Now the warning signs the chart will give you before the regime breaks. 2 of them. First, breadth divergence. If the index makes new highs while the percentage of components above their 50-day moving average falls, the rally is narrowing. That is classic late cycle behavior. Second, momentum divergence. If RSI prints lower highs while price prints higher highs, the engine is losing torque even as the speedometer reads faster. That preceded the last 3 meaningful Nasdaq tops. Now 3 scenarios for the rest of 2026, with the probabilities I would actually assign. Bull scenario, around 30%. Ives memory supercycle holds, earnings keep beating, breadth widens, and the Nasdaq pushes toward the 30,000 zone over the next 12 months. Base scenario, around 45%. Choppy uptrend. The index grinds higher with periodic 5 to 8% pullbacks, but breadth stays narrow and we end the year roughly 10% above current levels. Bear scenario, around 25%. Shilling's recession activates, or the Buffett valuation reset triggers. A 20 to 30% drawdown takes the index back to its 200-day moving average or below. That gives a combined 75% probability of finishing 2026 higher, but a non-trivial 25% tail of a meaningful drawdown. The lean is up, but the tail is fat. Plan for both. Bottom line. The structural AI trade is real. The index multiple supporting it is not. Our lean is cautiously bullish into the middle of the year and risk-aware into the second half. The data tilts up near-term on earnings and capex, and tilts down medium-term on valuation and consumer stress. Tactically, stay long the index in trend, but predefine your invalidation level, the spring pivot low and the 200-day. Add hedges on momentum divergence and breadth narrowing. The bulls are not crazy. The bears are not wrong. They are talking about different time frames. Trade the one you actually have. No hype. Just signal. See you in the next one.